I. Ability to determine and assess the seasonality of an industry. Many industries experience recurring patterns in demand, revenue, expenses, and operational activity throughout the year. The framework specifically emphasizes assessing industry seasonality to support forecasting, budgeting, inventory planning, and strategic decision-making. FP&A resources explain that seasonality analysis helps organizations anticipate predictable fluctuations in business activity, allowing management to allocate resources efficiently, optimize inventory levels, and improve forecast accuracy. Understanding seasonal trends is especially important in industries such as retail, hospitality, agriculture, tourism, and manufacturing, where demand cycles significantly influence financial performance. Seasonality refers to predictable and recurring patterns that occur at specific times within a year due to factors such as weather, holidays, customer behavior, economic cycles, or industry events. FP&A professionals analyze historical financial and operational data to identify seasonal peaks, troughs, and recurring trends. Common techniques include moving averages, seasonal indices, trend decomposition, and regression analysis. For example, retailers may experience significant sales increases during holiday seasons, while tourism businesses often see demand fluctuations based on vacation periods and weather conditions. Effective seasonality analysis enables FP&A teams to forecast revenue, staffing needs, inventory requirements, and cash flow more accurately while reducing operational disruptions caused by unexpected demand fluctuations. Assessing seasonality requires FP&A professionals to distinguish between seasonal patterns, long-term trends, and irregular events that may distort financial analysis. Industry guidance emphasizes that seasonal fluctuations should not be confused with structural business growth or temporary anomalies. For example, increased winter sales in apparel retail may represent normal seasonal demand rather than sustainable long-term growth. FP&A professionals therefore evaluate multiple years of historical data to identify consistent recurring patterns and isolate one-time events such as economic disruptions, supply chain issues, or unusual market conditions. Understanding these differences helps organizations develop more reliable forecasts, improve budgeting accuracy, and make informed operational and strategic decisions based on realistic business expectations. Modern FP&A teams increasingly use advanced analytics, machine learning, and predictive forecasting tools to improve seasonality assessment and forecasting accuracy. Business intelligence platforms, ERP systems, and AI-driven forecasting technologies help analysts process large datasets, identify hidden seasonal patterns, and update forecasts dynamically as market conditions evolve. Industry forecasting resources explain that predictive analytics can enhance seasonality analysis by integrating historical trends with external variables such as weather conditions, economic indicators, promotions, and consumer behavior data. However, technology does not eliminate the need for professional judgment. FP&A professionals must still validate assumptions, evaluate data quality, and interpret seasonal patterns within the broader context of industry conditions and business strategy. Finance professionals must combine analytical techniques, statistical understanding, operational knowledge, and business judgment when evaluating seasonal industry trends. Effective seasonality analysis strengthens forecasting reliability, improves resource allocation, supports inventory management, and enhances organizational agility during periods of fluctuating demand. As businesses increasingly rely on predictive analytics and continuous forecasting processes, the ability to determine and assess seasonality has become an essential competency for FP&A professionals responsible for guiding strategic planning, financial stability, and long-term organizational performance.